Welcome back. We're talking about understanding the multifamily investment pro forma and avoiding pitfalls on assumptions. This can be tricky. So we brought Tanner back in. We'll be asking him some questions. Tanner, welcome back.
All right.
You're almost at the home stretch here.
That's right.
Look, you've seen a lot of pro formas. You have your own deals. You see a lot of deals. Obviously, people are sending you stuff. What are some sort of pitfalls that you're seeing in looking at these pro formas that investors can avoid?
Yeah, so I think again, it's based on the level of the assumption, meaning how are you going to execute the assumption. So I alluded a little bit to it yesterday, but there was a deal that I was competing on. Basically an investor had mentioned, hey, I'm looking at this specific deal. He knew that I was trying to buy it. I was outbid by over $2 million on this property. And but the returns were far greater what they were pitching, what he was seeing than I was coming up with, and we were pretty efficient.
So you're thinking, how are they getting there?
Yeah, I mean, we're a pretty efficient firm, as you see. Like, we outsource a lot, so we pay what we use.
Right.
So typically, that doesn't happen to this level. We get beat on properties all the time on the bidding, but we got smoked. Well, on this particular property, we had both felt that there was about $200 of rent increase, in the market. We both were very similar in the CapEx dollars that we felt that we needed to spend to do so, and really we're spending CapEx dollars on the same items. The difference and this was to get $200 a unit popping of rent, you're doing a pretty major renovation, in the unit. The difference is that my year one occupancy, their year one occupancy maintained a level of 95%. The property had been 95, they were going to maintain 95% occupancy. The difference in my assumption is that my occupancy dropped down below 78% in year one, with the theory of how many we were going to turn, when we were going to turn them, that they were obviously going to move out.
Right.
That unit would be vacant for 2 weeks, and how many we would go. So,
seems reasonable.
But when you take, $200, now you're not losing just $200 of income. Let's say that those rents were $1,300, a month. And this was, call it 220 units. Yeah. As you can see that those are a lot of dollars that were being changed.
Sure.
So, but that pro forma, they bought the deal and they were able to raise it. And I don't know how it ultimately turned out, but again, it was a really aggressive, assumption. So another thing you'll see is rent growth that we've talked about in years 3, 4, 5. John even mentioned to it, it gets pretty difficult to say what's going to happen in 2023. Right. With that being said, all indicators, all sign, all data is pointing that we have shortages, that in theory we'll have high occupancy, so we should have some rent growth. But you'll see pro formas where there's lots of growth on years 3 through 5, and that's stuff you've got a question of, how much weight you want to put on that, especially on the return parameter.
And you're looking at that top number that they gave you on the return.
If I'm going to invest $100,000 and I think that I'm going to make $200,000 back in year 5, which include my $100,000, but most of that return comes from the sale of the property, then you really have to pay attention
in
to
scenarios like that exit cap rate and also the loan conditions at that period of time.
Exactly.
And how many buyers are in the market at that time that we don't know about.
Or if it gets fees, lots of times too, you have to, as an investor, this happened to me when I first started. I invested in the deal, and I think they projected, we're going to have a 7% cash on cash return. Invested $100,000. That year I made $7,000 of cash flow. The next year I did not make, it was less. It was probably like $6,300, $6,200, but it said I made 7.4% of cash flow.
So part of were you basically reducing your basis?
So what they're doing is, in their business plan, when they gave you a return, it went down to pay down your capital. So they're calculating the cash flow based off. So instead of getting paid 7% on $100,000, I'm getting paid off $93,000, right? Which boosts the cash on cash returns. So that's another little thing as syndicator when you're looking at is flowing. It's a nifty little trick, right? To boost those returns. So it's how are you paying back capital?
Yeah, and how is this calculated? And even to the point of on the business plan, like in year 3, how are you going to how did you weigh that in year 3, that growth, if that's where the return's weighing?
Yeah, I'm pretty stagnant on them. I mean, I think that most of the time, as we'll underwrite as a placeholder 3% rent growth, but we'll also underwrite expense
3%,
growth.
3%.
Yeah.
Yeah.
So 2.5. I mean, you know, if you're seeing a major cap rate change of, hey, we're buying it. I can't even say those numbers because it doesn't exist anymore. It used to be like, you know, you're buying it at a 5. No, now you're buying it at a 3.5.
Right.
Now that'd be the equivalent of, you know, you're selling it at a 2.5.
Sure.
And do we agree with those assumptions? Do you think that goes up? Do you think it stays the same? You know, all of it. So it's these little tweaks can have massive changes on the dollars.
Yeah, let's shift into fees now, because when those fees are earned, what those fees are. We had a question come in. What is a typical structure on a syndication fee? So take me through this.
Yeah, so you'll have, typically a syndicator is going to have an acquisition fee, which is usually based on the total purchase price. You'll see it depending on the size of the deal, anywhere from, call it a 0.5%. I've seen all the way up to 3% fee. Oftentimes the syndicator will roll all or part of that back in the deal or not. Any fees that they have to be disclosed. So sometimes people's fees that they don't catch would be like a construction management fee, which would be if you're doing a major CapEx renovation, sometimes the syndicator will charge a 5% fee on those dollars for overseeing that capital or those improvements. You'll see sometimes, then it goes to the property management fee. I'd say 3% is fairly standard. I have seen up to 5%. You will see sometimes syndicators will have an asset management fee that will also go I've seen between 1% to 3%. That's usually based off total income. That usually goes also to, you know, pay for the tax returns, that type of thing. Organization, there's debt fees. A lot of syndicators, or I don't see a lot of times where the syndicator takes a promote on the debt. Just usually the debt originator is going to charge a fee anywhere from 3 bips to 1.5%, depending on the size. And I do see a syndicator fee where if there's a refinance of the property, they'll charge sometimes 1% of that. And then there's typically a disposition fee when they sell the asset, which again goes from 1 to 3%. Those are fairly typical.
Yeah, that construction management fee, that's that project management and all that oversight. Because if you have this value add play, all of these things are taken into consideration. Yeah, that's awesome. And I know that all those are negotiated based on, sometimes the syndicators are moving those numbers around to get the deal done or depending on how everything's structured.
And that's another Proforma thing that if you're looking at your net return or what you think your return is going to be to the investors, are they calculating the fees and those expenses around the fees into their assumptions?
So that stuff gets like an expense hit first.
Right.
So you hit your NOI, then you boom, 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 you hit up then the pref, all the return, and then tell me what you'd like to see.
I just like to see the net. I mean, the real number, right? Yeah. I mean, because the surprise is never going to be good if the investor is expecting to hit a certain number, and then you're like, oh, well, wait, sorry, that's because that was before the fees. Well, you essentially know what the fees are. You're making an assumption saying if we sell it for X, we disclose that our fee is going to be 1% or what have you. Another times,
and the elite capital that is chasing you. They appreciate that disclosure, right? I mean, that's one of the value points of being a great syndicator or sponsors is coming up forward with these. So there are no surprises like that. That's not a call you want to take.
Right, and you're also, I mean, we're actually calculating tax on our exit. So we're putting an assumption in for the tax we're going to have to pay, the cost of the sale. So lots of times you'll see anybody throw an extra 1.5%. Depending on how much Tom's going to charge on, that type of thing. So all those costs get embedded into the sale, which, so if we sell it for X, it just changes your returns. So, and should be oftentimes, or at least for me, it's all netted out, and we show how that math works.
Yeah. And I know all this is deal specific, but this was great. Great overview on that. Gosh, appreciate you sharing the last 2 days with us.
Yeah, it was fun.
It's been awesome. We literally like extracted your brain there with information. So, and I'd love to have you back. I know we talked about the mastermind, and I'm going to let people get involved with that. But yeah, anything else we missed on the fees? And if not, we'll wrap up here.
No, thank you for all you're doing. It's great.
Awesome.